pattern has governed the interplay between precious metals and the broader financial markets. Institutions have observed that gold and silver rarely move without leaving distinct footprints in related equities, yet these signals often remain opaque to the public. Current behavior in mining stocks hints at forces that could reshape positions in both metals, suggesting a recalibration might be underway. Rick Rule has emphasized that market liquidity and sentiment are being tested in ways not fully reflected in prices. Available reports indicate large capital flows are probing the edges of mining stock valuations, searching for structural inefficiencies. If these forces intensify, they could ripple through both physical and paper markets, creating pressure points investors often overlook. At the institutional level, the distinction between bullion and mining equities becomes crucial. Gold and silver themselves carry different sensitivities to macroeconomic stressors than the companies that produce them. Rule points to the possibility that divergences we're seeing now may signal more than temporary dislocations. They could represent preemptive positioning by major stakeholders. Behavior in derivatives markets adds another layer. Open interest and unusual options activity suggest that some actors may be hedging against scenarios that are not widely considered. The implications for liquidity, particularly in silver, could be more profound than surface price movements indicate, leaving conventional analysis incomplete. Investor psychology, under these conditions, is not uniform. Those focused solely on the metal itself may miss subtle shifts in sentiment that first manifest in mining equities. Observing how these trends intersect with institutional positioning can provide early clues, but only if approached with a nuanced, data-informed perspective. Gold often acts as a stabilizer, yet its relationship to mining stocks can become counterintuitive during periods of strategic repositioning. Rule suggests that watching the spread between spot prices and futures could reveal underlying stress, especially when trading volumes start to concentrate in specific derivatives. Silver, historically more volatile, is drawing attention because its industrial demand profile can magnify reactions to market signals. Available market behavior implies that price movements in silver could precede shifts in mining equity valuations, making it a potential early warning indicator for institutional moves. Finally, the overlap of macroeconomic uncertainty and sector-specific pressures sets the stage for unusual correlations. Rule indicates that how these correlations evolve will likely dictate the next wave of capital allocation in precious metals. The question remains whether these patterns signal temporary inefficiencies or a deeper structural adjustment that could redefine risk-reward calculations. Institutional capital rarely moves without intent, and current patterns in gold suggest more than casual repositioning. Large accounts appear to be testing support levels quietly, probing for vulnerabilities without triggering overt volatility. Rick Rule has noted that such probing often precedes more decisive action, hinting at the potential for asymmetric moves that could affect both bullion and related equities. Market structure itself is under scrutiny. Trading desks are reportedly evaluating supply chain constraints, inventory levels, and delivery mechanisms across bullion markets. These details, while technical, have implications for price discovery. A slight imbalance or hesitation in one segment can cascade through the system, creating price pressure that is subtle but persistent. Mining stocks are responding differently. Unlike metals, equities reflect not just the underlying commodity, but also management decisions, operational risks, and financing conditions. Rule suggests that the current divergence between metal prices and mining equity valuations may indicate institutional hedging or strategic accumulation rather than market inefficiency. Options markets offer another layer of insight. Elevated implied volatility and concentration of positions in certain strike prices suggest hedging against scenarios that are not obvious from spot prices alone. Such activity can create feedback loops where derivative positioning begins to influence the underlying asset, adding a layer of complexity often missed by traditional analysis. Macro drivers remain critical. Interest rate expectations, currency fluctuations, and fiscal policy all weigh on gold and silver differently. Rule emphasizes that the interaction of these factors with mining equities is rarely linear. Small shifts in policy perception can amplify existing trends or trigger sudden corrections. Liquidity dynamics are increasingly relevant. Exchanges and OTC markets show pockets where volume is thin, meaning that even modest capital deployment can move prices more than anticipated. Rule points out that understanding these thin zones can provide an edge, especially in silver, where industrial demand and speculative interest intersect. Investor positioning continues to be heterogeneous. Some actors are defensive, others opportunistic, and a few are positioning for structural shifts that have little to do with current headlines. This mixture creates an environment where signals can be contradictory, requiring careful parsing to identify actionable trends. Finally, mining stock valuations may start to anticipate broader commodity moves. Rule indicates that tracking relative strength and unusual trading patterns in select equities can reveal expectations of future bullion price shifts. Yet the timing and magnitude of these adjustments remain uncertain, leaving room for strategic ambiguity. At the institutional level, risk assessment goes beyond raw price action. Rick Rule has stressed that understanding counterparty behavior, how major banks, hedge funds, and trading desks react to subtle shifts, is often more revealing than tracking market averages. These actors can create pressure points that ripple unpredictably through both metals and mining equities. Market sentiment, as reflected in both futures and physical flows, has shown periods of quiet accumulation. Rule notes that such accumulation can be deliberate, aimed at masking intent, while building positions ahead of anticipated macro events. When these positions reach critical mass, even minor triggers can produce outsized movements. Corporate fundamentals in mining also play a nuanced role. Cash flow, capital allocation, and operational efficiency influence investor appetite in ways that do not always align with spot metal performance. Rule suggests that when equities decouple from underlying bullion, it may signal strategic positioning rather than irrational pricing. Silver, in particular, exhibits asymmetric sensitivity. Its smaller market size compared to gold makes it more reactive to shifts in speculative capital. Rule observes that derivatives activity in silver often precedes visible equity adjustments, implying that institutional players are using silver as a tactical lever. Hedging strategies further complicate interpretation. Mining companies and investors deploy a mix of options, forwards, and swaps to protect against volatility, yet these instruments also transmit signals about market expectations. Rule points out that reading these signals requires a sophisticated understanding of both contract mechanics and market psychology. Macro correlations are not static. Gold and silver react differently to currency movements, interest rate expectations, and geopolitical developments. Rule emphasizes that the interplay between these variables can create temporary dislocations, which may present opportunities or hidden risks for mining stock investors. Capital rotation is subtle but detectable. Rule indicates that shifts from bullion to equities, or between gold and silver, can occur without dramatic price swings, but institutional balance sheets reveal these movements. Recognizing these rotations early can provide insights into potential inflection points in both metals and mining equities. Finally, the relationship between liquidity and market perception is increasingly important. Concentrated positions, thinly traded contracts, and strategic hedging can amplify minor disturbances into larger trends, particularly in silver. Rule implies that understanding these dynamics is key to anticipating the next series of moves. Behind closed doors, the interplay between bullion inventories and mining production shapes market expectations more than headlines suggest. Rick Rule has emphasized that supply data, often released with delays or aggregated at a high level, can obscure short-term stress points. These gaps in transparency create a subtle tension that informed investors watch closely. Derivative positioning adds layers of nuance. Elevated call or put concentrations in specific metals may indicate expectations of asymmetric risk, where downside protection is prioritized over upside potential. Rule suggests that tracking shifts in these concentrations can provide early signals of institutional repositioning. Equity market behavior sometimes diverges sharply from physical metal trends. Mining companies are affected by operational factors, geopolitical exposure, and financing conditions that gold and silver themselves are insulated from. Rule points out that such divergences are rarely random. They often reflect strategic hedging or targeted accumulation. Silver's liquidity profile magnifies these effects. Its smaller, less liquid market means that institutional flows can move prices more dramatically than in gold. Rule notes that subtle variations in trading volumes and spreads often precede more visible market reactions, making them critical early indicators. Hedging activity in mining firms also conveys hidden information. Forward contracts, options, and swaps reveal what management perceives as potential price ranges. When patterns emerge across multiple companies, it can suggest a coordinated response to anticipated shifts in bullion prices. Macro conditions remain a persistent undercurrent. Currency fluctuations, inflation expectations, and interest rate policy influence metals and equities differently. Rule emphasizes that understanding these differential effects is key to interpreting market signals correctly, as correlation patterns can change abruptly under stress. Institutional psychology is another crucial factor. Large players often test markets with small, deliberate moves to gauge liquidity and sentiment. Observing these tests, particularly in mining equities, can reveal strategic intentions before they become apparent in prices. Finally, price divergences between gold, silver, and their respective mining stocks often signal early adjustments. Rule warns that while such divergences may seem minor, they can precede broader repositioning, leaving those unprepared exposed to asymmetric risk. Historically, metals markets have responded sharply when institutional actors recalibrate exposure across bullion and equities. Rick Rule has observed that these recalibrations are rarely linear. They unfold in waves, with each movement testing the market's resilience and revealing latent vulnerabilities. Liquidity pockets often dictate the timing of these waves. Thinly traded silver contracts and lightly circulated mining stocks can experience outsized price reactions even from moderate capital flows. Rule points out that recognizing these zones of concentrated influence can provide early insights into potential market inflection points. Mining company fundamentals play an increasingly strategic role. Operational efficiency, cash position, and debt structure all affect how equities react to shifts in bullion prices. Rule suggests that the current divergence between physical metals and mining stock performance may signal anticipation of macro events rather than short-term mispricing. Options and derivatives activity continues to illuminate hidden positioning. Elevated implied volatility or clustering in specific strike prices can indicate risk hedging or directional bets by major players. Rule emphasizes that parsing these signals requires both precision and experience, as misreading them can lead to false conclusions about market direction. Silver's industrial demand introduces unique pressures. Supply-demand imbalances can amplify speculative flows, and Rule highlights that institutional participants often exploit these imbalances to optimize portfolio positioning. Observing subtle volume anomalies can offer clues about impending shifts before they manifest in price movements. Macro factors, including interest rate trajectories and currency trends, remain critical drivers. Rule notes that metals and mining equities respond differently to these forces, creating potential for short-term divergences that signal deeper strategic positioning. Such patterns require careful monitoring, as they may precede broader market realignments. Investor behavior reflects a spectrum of objectives. Some are defensive, others opportunistic, and a select few are strategically positioning for systemic changes. Rule underscores that this heterogeneity makes the market's reaction to triggers unpredictable, necessitating careful observation of both bullion and equity flows. Finally, the feedback loop between derivatives, equities, and physical markets continues to evolve. Rule indicates that understanding how these layers interact is crucial, as minor shifts in one segment can propagate across the system, subtly setting the stage for larger, coordinated moves. At the institutional level, timing often outweighs magnitude. Rick Rule emphasizes that capital moves are frequently staged, testing market response before committing significant resources. These subtle probes can leave patterns that, if identified early, hint at larger strategic intentions in both metals and mining equities. Market microstructure reveals pressure points that are otherwise invisible. Thin liquidity in certain silver contracts or lightly traded mining shares creates an environment where even moderate transactions can have amplified effects. Rule notes that these zones often become focal points for institutional testing, revealing the market's tolerance for shifts before larger reallocations occur. Corporate governance and management decisions increasingly influence equity performance. Mining companies with proactive hedging strategies or flexible capital allocation can absorb volatility more effectively, while less prepared firms may reflect bullion market stress disproportionately. Rule suggests that discerning these operational differences provides a window into broader market expectations. Derivative flows remain a critical lens for understanding positioning. Option skew, futures open interest, and concentrated hedging activity can reveal the implicit expectations of large players. Rule emphasizes that shifts in these signals often precede observable price movements, making them valuable early indicators of institutional intent. Silver's dual role as both a commodity and a speculative instrument introduces asymmetry. Its industrial demand can amplify reactions to macroeconomic cues, while speculative positioning magnifies short-term volatility. Rule highlights that institutional participants often exploit this duality, creating opportunities that remain hidden to conventional market watchers. Macro dynamics are constantly recalibrating risk. Interest rate trajectories, currency fluctuations, and fiscal policy shifts do not impact gold, silver, and mining equities uniformly. Rule notes that understanding these differential effects is essential to anticipate where capital may rotate next. Investor psychology adds another layer of complexity. Defensive hedging, opportunistic positioning, and anticipatory speculation coexist, generating patterns that are subtle and sometimes contradictory. Rule underscores that interpreting these behaviors requires a disciplined focus on both qualitative and quantitative cues. Finally, the interaction between liquidity, derivatives, and equity positioning sets the stage for asymmetrical outcomes. Rule indicates that minor disturbances in one segment can cascade across others, amplifying movements and signaling strategic adjustments that are not immediately apparent in spot prices. Behind institutional decisions lies a careful assessment of systemic risk. Rick Rule highlights that large players rarely act in isolation. Their moves are influenced by anticipated reactions across multiple layers of the market. Understanding these interactions can reveal pressure points that precede significant shifts in both metals and mining equities. Market signals are often encoded in subtle price and volume patterns. Thin trading in silver, unusual spikes in open interest, or concentrated options activity can provide clues about where institutional capital is quietly accumulating or distributing. Rule stresses that these patterns, while subtle, carry disproportionate informational weight. Equities are reflecting more than bullion exposure. They incorporate operational and geopolitical sensitivities. Mining firms with diverse assets or robust balance sheets can absorb shocks that affect their underlying commodities, while less flexible companies may magnify market stress. Rule suggests that monitoring these distinctions can anticipate where capital may migrate next. Derivative positioning continues to illuminate hidden expectations. Elevated call or put concentrations, unusual strikes, and futures spreads can indicate hedging against scenarios not apparent from spot prices alone. Rule emphasizes that reading these signals requires contextual understanding of both contract mechanics and market psychology. Silver remains particularly sensitive to these dynamics. Its smaller market size and industrial applications amplify the effects of concentrated flows, creating early warning signals in both equities and bullion. Rule indicates that recognizing these signals before they appear in price charts can offer strategic insight. Macro conditions remain fluid. Interest rates, currency volatility, and policy shifts do not affect gold, silver, and mining equities uniformly. Rule notes that analyzing how these variables interact across different asset classes can reveal which segments are likely to lead or lag in the next wave of market activity. Finally, investor behavior is a mosaic of objectives and strategies. Defensive hedging, opportunistic speculation, and anticipatory positioning coexist, generating overlapping signals that require careful interpretation. Rule stresses that the ability to parse these layers is essential for understanding how institutional moves may unfold in the coming months. At the intersection of bullion, mining equities, and derivatives lies a complex network of feedback loops. Rick Rule observes that small adjustments in one segment can propagate across the system, subtly shifting risk perceptions and influencing subsequent allocations. These interactions often occur without obvious triggers, making them difficult to anticipate for the average observer. Institutional monitoring of correlations is constant. Gold, silver, and their respective equities can decouple temporarily, signaling either hedging activity or preemptive repositioning. Rule points out that recognizing these decouplings early can provide a strategic advantage, revealing where capital might flow before broader market participants respond. Liquidity remains a defining factor. Thinly traded mining stocks and lightly circulated silver contracts amplify the effects of institutional moves, creating pressure points that conventional analysis may miss. Rule suggests that understanding these zones can help anticipate volatility and uncover hidden patterns of accumulation or distribution. Derivative signals, including option skew and concentrated futures positions, act as an undercurrent shaping market behavior. Rule emphasizes that these instruments are not just hedging tools, they communicate expectations about potential market stress, directional bets, and risk tolerance of major players. Silver's dual role, as both a commodity and a speculative instrument, continues to create asymmetry. Its industrial applications introduce baseline demand, while speculative flows can magnify short-term reactions. Rule indicates that institutional participants exploit this duality strategically, setting up moves that may appear disconnected from immediate market fundamentals. Macro drivers remain ever present. Interest rate forecasts, currency trends, and policy announcements interact differently with metals and equities. Rule highlights that nuanced understanding of these interactions can reveal where liquidity might rotate next, shaping both short-term and longer-term positioning. Finally, the mosaic of investor behavior, ranging from defensive hedging to opportunistic positioning, creates overlapping signals. Rule underscores that interpreting these signals requires both patience and analytical rigor, as small coordinated shifts can precede larger structural adjustments. The implication is clear. Understanding these dynamics is critical for anticipating the next wave of institutional moves across gold, silver, and mining equities. In assessing the current landscape, Rick Rule frames the situation as one defined by subtlety and layered complexity. Gold, silver, and mining equities are interconnected, yet each responds to macroeconomic, operational, and psychological forces in its own distinct way. Institutional actors are probing, hedging, and quietly repositioning, creating patterns that are often invisible to casual observers but critical to understanding potential market shifts. Liquidity, derivative positioning, and equity fundamentals all serve as instruments of insight. Minor imbalances or concentrated flows can propagate through the system, amplifying small signals into larger movements. Rule emphasizes that these dynamics demand careful observation, disciplined analysis, and a recognition that apparent divergences often mask strategic intent. Silver, with its smaller market and dual role as both industrial metal and speculative asset, exemplifies the asymmetric pressures at play. Gold provides stability, but even its movements must be interpreted in the context of broader institutional positioning and macroeconomic drivers. Mining equities serve as both a reflection of and a lever for these dynamics, bridging the gap between physical metals and financial speculation. Ultimately, Rule underscores that successful navigation requires a layered understanding, monitoring correlations, interpreting derivative flows, evaluating operational fundamentals, and tracking liquidity zones. The market is rarely random. It is shaped by deliberate, sometimes opaque strategies that, when decoded, reveal the next potential moves in metals and mining equities. Recognizing these patterns early provides insight into where capital may flow, where risk may concentrate, and how both bullion and equities may respond in the months ahead. This concludes the script.